At the end of the last trading week, traders were ready to receive a weak employment data in the United States, and the US dollar was moving lower under these expectations. Yet, things took a different turn. The data presented by the US Department of Labor massively exceeded the forecast, showing that payroll gains in September were almost double the consensus value. Naturally, this report stirred high volatility in the market. The US dollar index, which gauges the dollar's performance against a basket of 6 other major currencies, surged to the upside, but closer to the end of the week. It returned to the opening level of 106 points. Traders were trying to predict the next move by the US Central Bank. At the same time, they did not want to leave their positions open for the weekend, so we could see some profit taken on the long positions. On the chart, this is reflected by sharp price swings. The new week started with the escalated tensions in the Middle East. Safe haven assets and oil are the main instruments to benefit from this news. We will cover this in more detail in our regular video reviews. The euro-dollar pair also returned to the levels where it started the previous week. At some point in trading, the pair dropped to its lowest level since November last year. This is how market participants react to the divergence in the interest rate policies of the two central banks. The US Federal Reserve is now expected to introduce another rate increase by the end of this year, which may be confirmed in the latest minutes on Wednesday. Meanwhile, the European Central Bank is signaling the end of the tightening cycle. What's more, the incoming macroeconomic data from the Eurozone intensifies expectations that the ECB may start easing its policy as soon as the first quarter of 2024. The pound sterling managed to gain some ground in the course of the previous week, although it still suffers from the interest rate divergence between the Fed and the Bank of England. Investors anticipate that the UK regulator is now nearing the end of the tightening cycle. The existing monetary course of the Bank of Japan provides little support to the national currency, which is why the Japanese yen is continuously depreciating against the US dollar. However, the yen accelerated strongly against the greenback over the past week, fueling speculation about monetary intervention by the Bank of Japan. Yet the regulator did not confirm this fact. Most likely, the surge was caused by a large volume trade initiated by some big market players, which was later picked up by other major banks trading and dollar-yen pair. This is another indication that the pair is closely watched by market participants. Trader sentiment regarding the US dollar naturally affects gold prices. Stronger than expected US jobs data heightened expectations of additional rate increases by the Fed. Higher interest rates raise the cost of holding gold bullions and make them less appealing to investors. Today, the precious metal advanced to meet geopolitical tensions in the Middle East. The Palestinian militant group Hamas launched a surprise attack on Israel on Saturday, prompting a series of retaliatory actions from Tel Aviv and bringing the total death toll on both sides to more than 1,000. Investors fear that the conflict may escalate further amid accusations that Iran was behind the attacks. Given that the current events directly affect oil-producing countries, oil prices surged to $88 per barrel on Monday. Over the past trading week, oil was slowly declining amid concerns over subdued global economic growth. Crude prices dropped by more than 8% in the past week as the high interest rates made global economic forecast even gloomier. You have watched combat review of currency and commodity markets on the InstaForex TV channel. We wish you profitable trading and see you online soon.